There's a common denominator among gold bugs and Bitcoin investors, and that's the distrust in the US government. Now, a lot of people don't like this chart here. This is the ever-increasing US deficit, as in the US is spending more money than it's taking in via taxes. And this seems to be a pretty problematic situation, right? This is the US global debt. This is in orange. But is this actually really a problem? We always hear this in the news. The debt is rising, and then the government is forced to increase the debt ceiling. Now, the issue is that that debt is denominated in a currency that devalues over time. So because there's so much debt, there's also more money printing going on. And the money printing is reflected here. This is USM2, the money supply in the US. It went from 1.6 trillion in 1980 to now 21.5 trillion. Now, this is on average a growth rate of 5.8% per annum. And so this explains a lot of the returns that we get in the markets, right? If we have stocks and they appreciate by 6-7%, a lot of that appreciation is not necessarily the company becoming better. It's just the devaluation of the US dollar. And that's why we don't want to hold just fiat currency in an account without any return, or that's why we don't want to hold like physical cash. We want to have something that can keep up with monetary expansion. But then the question arises, is it really a problem that the US is getting into more and more debt? And as in, how quickly is the debt actually going up? One might make the argument that owning a lot of debt is actually favorable because the debt over time devalues, right? Because there's more and more money floating around. This is how a lot of people make money with property. If you're paying down 10% on a house and 90% is financed, and then you pay this off over time, and the financing is very, very cheap. Let's say you got this locked in for 3% per annum. But now the monetary base expands by 5.8% per annum. That means every year you're making money because the 90%, all of that money that's in the property, that devalues. It gets easier and easier every year to pay off the debt. And so your house should increase in value by an average 5.8% per year. And so you're making all of that appreciation, but the debt isn't really as expensive as what you make comparatively with the appreciation of the house. Debt becomes a problem when servicing the debt is getting too high, when it's too high relative to our cash flows. And we can look at this ratio for the state level as well. Here's the interest payments by the US government over time. And of course, this goes up the same way how USM2 is going up because the monetary base expands over time and the US dollar is worth less and less. Now this here is the current tax receipts. And so what really matters is what's currently the interest payments relative to how much tax is made. So I imported that data into an Excel sheet. It starts in 1947, goes all the way to January of 2024. So we don't have any newer data than that, unfortunately. But that's then the resulting chart. So tax receipts are in orange and the interest payments are in blue. And of course, when the interest rates are higher than the tax receipts, that's when the government goes bust. And so the ratio between the two over time is actually what matters. Now that ratio is impacted by the interest rate as well, right? We all know how interest rates go up and down, but here's the ratio. What percentage of tax receipts had to be used to cover interest rate payments? And this was at one point above 50%. And of course, that was during the time when also interest rates were pretty high. But still, we aren't at that elevated level yet. If interest rates were to double again and we would go to 8% or so, then we might have a problem because then we'd hit a new all-time high in the interest payment to tax income ratio. But right now, everything is fine, right? This would only become a problem if suddenly inflation rates rise again to 10 or 15%, and then the Federal Reserve is forced to push up interest rates as a consequence of that. But the officially measured inflation rate tends to rather go down, right? It's at 2.7%. It spiked a bit after the COVID stimulus at 9%, and the Federal Reserve had to react to a degree, right? The interest rates went above 5%, but now things are coming back down. And everything seems to be fine. In the last 40 years, we had an average interest rate of maybe somewhere around 3%. And we are pretty close to that average. And so it's unreasonable to assume that this will change over the next 20, 30, 40 years. Yes, we might get our spikes in the inflation rate every now and then. Yes, people are also somewhat spooked with the tariff war, with the trade war. That could also raise consumer prices, but that won't happen forever. Again, at one point we had been above 50% of tax income just going towards interest rate payment. We are very far away from that now. We are only at 36%. Here was the peak, by the way, in 1985. And so, of course, it doesn't hurt to reduce government spending, but the US government is far away from being bankrupt. It's simply just highly levered. And long-term leverage is, of course, a good thing when the debt is cheaper than how quickly the money devalues over time. If you're paying somebody 3% per annum, and at the same time you've got a money printer that prints 7% per annum, that's a good place to be in, right? You want to play that game for as much as possible. So the government is actually the beneficiary of that game. The people that are not beneficiaries are bondholders, and that can be retirees, that can also be foreign countries that bought US government debt. And that's also the reason why I don't think it's a good idea to hold long-term government bonds for a long time. If you want to be risk off, it makes sense to rather simply buy other assets that can keep pace with monetary expansion, but that still don't crash during times of turmoil, for example, precious metals. Because have a look at this chart. This is TLT. So this is a long-term government bond ETF, and it tends to go up as we saw monetary tightening. Then when monetary policy gets more loose, then of course the price of bonds goes down. So there's an inverse relationship. But just have a look at TLT relative to monetary expansion. So how much is your US government bond worth relative to how much money is being printed? And that's the chart. You are losing purchasing power buying long-term government bonds over the long term. And this is very, very consistent, independent of monetary policy. We saw quantitative easing and quantitative tightening during that period. What works better is gold. So this is a very long-term gold chart relative to monetary expansion. Recently, gold is going up, and we had our boom and bust cycles, and they are very long in nature, several decades to be exact, but currently it seems like gold is a pretty good bet. It's definitely better than US government bonds. The US government is making money by having debt, and it doesn't look like it's at the edge of imploding anytime soon. And so the reason to buy gold and the reason to buy Bitcoin is not necessarily in order to hedge against the ultimate collapse. It's simply just to hedge oneself against the monetary expansion. And if you don't want to buy stocks, because stocks might be expensive, say relative to earnings historically, then we can buy something that's relatively risk off, or at least that's somewhat not so correlated to stocks. And so crypto simply gives us another option, another asset class, besides property and precious metals and stocks, etc. Right? We just want to be more diversified. Crypto is a good hedge, especially Bitcoin. It doesn't expand that quickly. And because of all of that data, I believe that the things that happened in the last decades are likely going to continue. So the US is likely going to stay the superpower of the world. The US dollar isn't going anywhere. It will stay the leading fiat currency. Yes, it will devalue over time. Yes, it's not a great store of value, but it will stay the leading payment network, right? The leading way to exchange value across countries even. I'm looking forward to feedback directly below this video. I can imagine there are quite a few people that disagree. Feel free to also subscribe. I publish videos regularly. A like would be very much appreciated as well. Helps the channel grow. Feel free to also check out the premium membership. So this is where I share what kind of portfolio I have, what kind of trades I open in order to beat the market. There's also a lot of tutorials where there's more to be learned about how to potentially exploit all of that monetary expansion and make more money than all the rest. So see you again on YouTube, or potentially also in premium at thebitcoinstrader.com. Cheers!